It's essentially impossible to determine which investment strategy is best when everyone has an opinion and nobody backs them up with real data. So instead, I tested and graded the 4 most popular investment portfolios through the same 3 metrics that professional investors use: allocation, risk, and return. And considering how equally popular these portfolios are, it was shocking to see how different the results were. Because one of these portfolios lost a quarter of its value in a single year, and another turned $10,000 into nearly $40,000. The first category is allocation, and this is where you start to see why some portfolios are built to survive and others are destined to fail. Think of it like building a house. You could build it out of just one material, but if you want to survive a storm or an earthquake, you need the right combination of materials working together. And portfolios work the same exact way. So when grading allocations of investment portfolios, you have to look at how much you are investing in 3 basic categories: US stocks, international stocks, and bonds. Let's start with the first top portfolio, the S&P 500. This portfolio is 100% VOO, which is Vanguard's S&P 500 ETF. That means that your entire portfolio consists of the top 500 publicly traded companies in the US like Apple and Nvidia. Now, there's been a major tech and AI boom over the past decade, so 33% of this portfolio consists of the tech sector, which is a lot. And it's a concentrated bet too, because you're only betting on one country's economy with no stable bonds to help cut their losses when they fall. So because this portfolio is so exposed, it gets an allocation grade of 3 out of 10. The second top portfolio is called the 3-fund portfolio. 70% of this portfolio consists of VTI, which covers the total US stock market, 15% consists of VXUS, which covers the international stock market, and 15% BND, which is the US bond market. Now, you can change how much you allocate into these funds based on your age, but for simplicity's sake, we're going to use this allocation that's pretty standard for investors of this portfolio. This portfolio fortunately covers the 3 basic fund categories of US stocks, international stocks, and bonds. And on top of that, the bond and international allocations are meaningful enough to cushion US stock volatility, but small enough to reap the rewards when the US economy skyrockets. So the textbook 3 fund gets an allocation grade of 10 out of 10. The third top portfolio we are analyzing is Dave Ramsey's portfolio, which you might be familiar with. While Dave's teachings on getting out of debt and living on less than you make are amazing, his allocations are questionable. While he doesn't say specifically which funds he recommends, I have some insider scoop of funds that would qualify under his requirements. His portfolio is made from 4 funds shown here, evenly split at 25%. And these 4 funds reflect these 4 categories: growth and income, growth, aggressive growth, and international stocks. Now, on the surface, this looks diversified with 4 distinct funds, but it's really not. Every single fund in this portfolio is a growth fund, which basically means that they are highly volatile when the market crashes. So even though it covers international stocks, there are no bonds to soften the crashes in the economy, so Dave gets a 4 out of 10. The fourth top fund we are testing today is the no-brainer portfolio, which is split at a 25% share evenly across 4 funds, just like Dave's. This portfolio consists of VOO, which is the S&P 500 or the top 500 US companies we mentioned earlier, VB, which is made up of smaller US companies, VXUS, which is international stocks, and BSV, which is short-term bonds. It's great because just like the 3 fund, it covers bonds, US stocks, and international stocks. But the issue here is that there is no data to justify having 25% go towards both smaller US companies in VB and larger US companies like VOO, because larger US companies have outperformed smaller US companies over the last 10 years when the economy booms and when it falls. Now, there have been periods of time where smaller company indexes have outperformed the S&P 500, but there is no data to justify giving them the same weight in your portfolio. So for allocation, it gets an 8 out of 10. Now we know which portfolios are built to survive on paper. The next question is how they will actually hold up when the markets get ugly. Every single portfolio has some amount of risk, which isn't necessarily a bad thing because you can't have meaningful returns without risk. The real question is whether the risk of these portfolios is actually being rewarded. And to measure that, we look at 3 things: The first is how much your portfolio swings up and down in a single year, or its standard deviation. The higher the standard deviation, the more the portfolio swings up and down, and the harder it is to stay invested when things get rocky. Looking at the data, the S&P 500 sits at 14.93%, the 3 fund at 13.03%, Dave Ramsey at 16.92%, and the no-brainer at 11.62%. The second data point we need to look at is the max drawdown, or in other words, what has been the worst case scenario for these portfolios over the past 10 years. Now, to put these numbers into perspective, if you had $100,000 invested, this is how far your portfolio would have dropped. The S&P 500 drops to 76,000, the 3 fund drops to 76,400, Dave Ramsey's drops to 68,000, and the no-brainer drops to 79,800. And third, we have to consider if this risk you are taking on is actually worth it. Think about it this way. You are offered 2 jobs. One pays $100K a year and guarantees you a predictable 40-hour work week. The other pays you $105K, but you might be working 80 hours on random weeks with no warning. Most people would take the $100K job because the extra $5,000 is not worth the extra stress and unpredictability. That is exactly how to measure whether investment risk is actually worth it. It's called the Sharpe ratio, and all you need to know is that the higher the number, the better return you are getting for the risk you are taking. Dave Ramsey's portfolio has the worst Sharpe ratio of 0.55, then the no-brainer at 0.61, then the 3 fund at 0.72, and finally the S&P 500 at 0.81. So for risk, Dave Ramsey comes in last with a 2 out of 10. It's the most volatile, worst drawdown, and lowest return for risk taken. And when the market fell, this portfolio actually fell farther than the market itself. The S&P 500 gets a 7 out of 10. The return per risk metric was the strongest at 0.81, but it carried the worst drawdown and the highest volatility of the 3 remaining portfolios. Basically, it was a rocket ship this decade, but you felt every bump. Next, the 3 fund gets an 8 out of 10 for being strong across all 3 metrics. And the no-brainer takes the top spot with a 9 out of 10. It had the smoothest ride, best worst case scenario, and the bond choice specifically protected it in 2022 when other bond funds collapsed. The only thing keeping it from getting a perfect score is a 0.61 on the return per risk metric, which was the lowest of the 4. Now we know how these portfolios are built and how they hold up under pressure. So which one actually made the most money? Well, the S&P 500 compounded at 14.09% per year and turned $10,000 into $37,800. The 3 fund compounded at 11.25% per year and turned $10,000 into $29,300. Dave Ramsey returned 10.78% per year and turned $10,000 into $26,700. And the no-brainer at 9.06% turned $10K into $24,000. But before you go out and buy the S&P 500 and put all of your money into it because it has the highest returns, you have to look at the full story. Something happened between 2000 and 2009 called the lost decade. Between the dot-com crash and the 2008 financial crisis, the S&P 500 returned -9% over that entire period. Much different than the 14% we're seeing today. Also, one of these portfolios has significantly higher fees than its competitors. The S&P 500, 3 fund, and no-brainer all cost you about 0.03% or $3 for every $10,000 invested. That's basically nothing. But Dave Ramsey's portfolio charges you 0.86% of your portfolio every year. That's 28 times more expensive than everything else and has the worst returns. 0.86% might not sound like a lot, but over the course of 30 years, that can compound and cut your returns by tens of thousands of dollars. So the S&P 500 gets a 9 out of 10 for the best returns and end balance, but the lost decade caveat prevents it from getting a perfect score. The 3 fund gets a 7 out of 10 as it had the second best returns, but was still $8,500 behind the S&P 500. The no-brainer gets a 6 out of 10 for solid returns, but was held back by its small companies' underperformance. And the Dave Ramsey portfolio gets a 4 out of 10 for its high fees and low returns. So what are the overall rankings? Well, if you've been paying attention for more than 30 seconds, you probably already know that Dave Ramsey is last. The high risk, low returns, and poor allocation gives this portfolio a 10 out of 30. In third place with a score of 19 out of 30, primarily because of its concentrated bet on one sector of one economy, we have the S&P 500. In second place with a 23 out of 30, we have the no-brainer portfolio for its low risk and great diversification, but held back by its lower growth. And in first place, which is my personal favorite, we have the 3-fund portfolio at a 25 out of 30. It's perfectly allocated, built to withstand any market environment, and essentially free to hold. So if you are the average investor looking to buy and hold for the next 30 years, the data points here. But not every person is the same, and I don't believe the 3-fund portfolio is necessarily the right fit for everyone. You can afford to take on much more risk if you are investing money you plan on keeping in the market for 30 years versus 5 years. And some people genuinely can't stomach watching their portfolio drop 23% without panic selling. And that's okay. Because the most expensive investment mistake you can make is not picking the wrong portfolio. It's panic selling the right one at the wrong time. And now you know exactly why the results ended up so different from each other. The portfolios that are built the most soundly are not always the ones that win a single decade, but they are the ones most likely to still be standing at the end of the next one. If you want to learn more about the 3-fund portfolio, I did a full breakdown that you can check out here. And if you want to learn more about money with real data and no bias, subscribe and smash that like button. Thank you, my friends, for watching, and I will see you next time.